Hi everyone, welcome. We're just waiting for everyone to come in via the waiting room. So we'll be kicking off in a moment, won't be long. Okay, we might get a start. We can do the housekeeping while there's a few more people to come on through. Good afternoon or good evening, everyone. My name's Paul Lynch. I'm the National Relationship Manager for the Australian Catholic Super and Retirement Fund. And welcome to our webinar today on getting your superannuation on track. So today we're just going to go through a few brief things, but before we start the session, just a bit of housekeeping and of course the acknowledgement of country. I would like to acknowledge the traditional custodians on the land of which I work and live, and recognising their continuing connection to land, water and community. I pay respect to past elders of the past, present and emerging. Okay, thank you everyone today for attending this webinar. If you haven't attended a webinar or a financial services company presentation before, we always have to start with a disclaimer. We have to get our compliance people happy and ensure that we meet our regulatory obligations. So therein lies our disclaimer. To provide a very brief summary of that is that we would like to highlight the fact that today's presentation is just based on factual information. It's not taking into account your personal situation, so therefore it cannot constitute as long as financial planning advice. So I would recommend that you read our product disclosure statement that would be appearing on our website at www.catholicsuper.com.au. And also there's some fact sheets in regards to the fund operation, fees, costs, investments and the like. We do highlight the fact that past performance is not a reliable indicator for future performance, and that all of the relevant disclosure requirements are listed in that disclaimer. So welcome to today's presentation in terms of getting your superannuation on track. Now, there are a number of things that we're going to be going through today, and for the convenience of the session, we have muted microphones down, but you are more than welcome to have some questions, or if you have any questions, to send them through the Q&A box down the bottom of the screen. If you type up your session, I will try and keep an eye on those during the session today and be able to answer them during the session, but if not, I'll certainly come back to those at the end of the session. So if you've got any questions, Q&A or the question and answer Q&A facility, and ignore the chat facility for the moment. I suppose in other requirements is that you will be sent or forwarded a survey at the end of this session. So we do appreciate your feedback and certainly comments in regards to how we can improve, how we can add other things that are of relevance or of interest to you that you would like to find out. So today, I suppose what we're looking at is that we're getting your super back on track. We need to strip down and basically go to the point of, well, how much super do you have and how you can improve your situation? How much do you need for your retirement? How, I suppose, that what can you do to remediate what has occurred? How do you improve it? How do you boost your superannuation? So we'll be certainly looking at through a number of items that we think that are relevant for today's session. The other item is that we'll be going through our member portal where you can, I suppose, take control of your account. You can log in, go through the website and see some facilities, and I'll give you some tips and traps in regards to that. And last but no means least, on how we can help. So I suppose the very first question is what we need to establish is that, well, how much super do you have? It's really important to make sure that you have a look at your account. I suppose there are a number of people where they may have multiple accounts. So start having a look at the superannuation statements. I know for the fact that in September, early September, we forwarded out to members the annual statements for the 30th of June. But if you can't find that copy, I would recommend that you log onto your portal and at least have a look at your account as to where it stands. It's quite a, sometimes people are obviously It's not something that they regularly do, but keeping up to date of making sure that your employer is contributing to your super account on a regular basis is critical. You can possibly have a look at, well, can I afford to add a little bit more? What options do I have? But I would certainly think that the first port of call is making sure that your employer is remitting the compulsory 10% super and it matches up to your pay slip. I suppose it is critical to know what's going into your account and how you can improve the situation, because at the end of the day, we have got to provide for retirement benefits. Now, one of the key features of superannuation is, yes, to accumulate wealth for retirement, but we also need to have some protection in there if things go wrong. So within your superannuation account and with Australian Catholic Super, we provide you with insurance benefits. So we need to have a bit of a review to make sure that your insurance benefits are reflective of what your situation is. Do they provide enough cover? So that's certainly an area that we need to have a look at to make sure that we've not only got planned for the now if things go wrong, but we also want to make sure that down the track at the wonderful age of when we can retire, to make sure that we've got enough there to provide for a comfortable retirement, meeting your goals, meeting what your dream of is for retirement, for your retirement account. So it's certainly by having a look at what you've got now, will start a bit of a journey as to where you go, as to what you need to do, and to hopefully get to a balance of, you've had a long, hard working life and you want to get a balance that you deserve. And so that, to give you a rich and rewarding retirement. So it's certainly areas where we need you to address. I suppose the one thing that I would mention on screen there is got our portal. You can actually log into your account. Now, for those people that have never gone to our website, www.catholicsuper.com.au, you can log into your account. But please note, we must have a mobile phone number and an email address on file for you to do so. It's not too hard to register. Go into the portal and log in to the top right-hand corner of the screen and hit login. If you have never logged in before, providing we've got your mobile phone number and contact details, you can register for the system below the login factor and then go through the processes of setting a password. If you've forgotten your password, I would suggest that you hit underneath the login section, hit forgot password, and then you'll be detailed and forward through some PIN numbers of what you can have a look at. We've really made some changes to our portal over the years. And the one thing I think, it's quite user-friendly. It gives you a bit of a snapshot of where your account is at the moment, gives you a snapshot of where it's been for the last few years in a nice few bar charts, but it also gives you a running summary of your accounts with contributions that we've received this financial year, your investment earnings for this financial year and the like. So, and how we've derived your account balance as it stands today. So there are a few items that you can do once you're in this portal. Once you're there, you can obviously view your account balance, but more importantly, people are looking at it to review their investment options. And I'll come back to that in a moment when we talk about your investment options with the fund. There are, within superannuation, there is 14 different products that you can choose from. So you can flick between those if you wish at any given point in time. It comes with its perils, like we do recommend that you set a portfolio that suits your appetite and stick with that product. But certainly by making changes every day, I would certainly think that superannuation is a long-term vehicle. You may not be able to have access to that area. So I suppose the other thing, as I've mentioned there, you get a running total of your account. It's got investment earnings and the like. And you can also, add in lump sum contributions there as well. You can update your details and also plop in your beneficiaries. The one thing that I would say is that if you're wanting to do a binding nomination, you will need to still do that in writing. But more importantly, members are now looking, or I'm sending members to there to have a look at their insurance cover And if they want to get a quote on increasing that insurance cover, they can do that through the portal as well. And then they can also apply and go through that process. It's quite an efficient system. So certainly, first step, I think if you're going to get your superannuation on track, log in. Take an interest into your account, review your statements, have a look at your account, see what additions you can do. The one thing that I would always say is that if there's any issues with your account, call the call centre. If you want to have an update on your account and have a bit of a run through, we've got regional staff that would be able to assist you and run through items that you might want to consider. But we'll talk about that in a moment. There was a question there from about this session tonight. Yes, it is being recorded, and it will be on our YouTube channel for later viewing if you wish. So I suppose the question I always find a little bit perplexing is, well, how much super do you have and how much super do you need? I think the very first thing is that we always see these, and I'm going to say awful media articles, where we talk about that you need $1 million to survive in retirement. I'd like to actually just blow that myth away for the moment. I don't think it's quite accurate, in the sense that, yes, if you retire early, if you're requiring a high level of income in retirement, you might need $1 million. But the general fact is that not too many people can accumulate a huge amount of wealth. So there is an organisation that does a study on recent retirees across the country. Now, if you want detailed information in regards to this, I always tell people to Google the ASFA retirement standard. And you can either download the long version of the document or the short version of the document. And what it's done is that it's researched what people are spending in retirement now. Now, they believe that a comfortable retiree retiring at 65, a single retiree, requires around about $545,000 a year to fund their retirement. Now, there are many assumptions in this document, assuming that you own your own home, debt-free, retiring after 65, and living a long and extensive life. That's the ideal retirement. So they're saying there for a single person, $545,000 is what they need in retirement. That is based on them requiring $44,818 there, that's listed at the bottom, as their income in retirement per year. Now, the general fact is that many of us will be eligible. Planners that we have in our organisation talk about, over 70% of Australians rely on some form of income from Centrelink in retirement. But what that's saying is that, okay, to live a life for a single person of $44,818 in retirement, they need that $545,000 worth of capital. For the couple, comfortable retirement, it's $640,000. Okay. Now, I would bring you back to the modest lifestyle. So the document does provide differences between what is considered a modest and what is provided a comfortable. I'll go through those in a moment. But you can see there, let's go back to the single example. I always use the simplistic mathematics, in the sense that a single person for a modest lifestyle is around about $28,500 a year. That's what they need to live a modest lifestyle. You might find, or you do find, that age pension maximum payment for a single person, let's say, is around about $4,000 less. Okay, so you get the full age pension. The requirement is about $4,000 more to live a modest lifestyle. I would always tell people that the difference being about $4,000 between age pension and that of a modest lifestyle. If you need $4,000, assuming no interest over the course of your life in retirement, you retire at 65, you live for 30 years in retirement, you need $4,000 a year, that's $120,000 to get you from the base of the age pension through to a single person for a modest lifestyle. So we're not talking about hundreds and hundreds of thousands of dollars here that make it, yes, they do make a difference. But we're also talking about, well, look, if you've got a smaller account balance due to, circumstances in your life, well, then you don't need to accumulate this massive pool to make a massive adjustment to your life in retirement. We might be talking about here that, well, if you do nothing, you might get to $100,000 by making a few tweaks over the last few years of your working life. It might mean that you get to the $120,000 in retirement and therefore be living a little bit more than what we have for the age pension. So there are some, I suppose that we've got to have a look at what are our goals in retirement, where we would like to sit, okay? Are we happy with a modest lifestyle? Are we happy with a comfortable lifestyle? So therein lies the issue is that, well, what's our hopes for our retirement and sort of what capital do you think we need? Now, the one thing, and I do apologise for the print on this one, we've tried to get the best there. Like it says here, do the values of comfortable align to your values? Now, just to read out a few points there is that the comfortable retirement for that income of $60,000 a year, $63,000 a year, it's staying there that to the criteria of what you need to spend on is that, yes, it does have one annual holiday in Australia every year. You regularly eat out at restaurants. You own a reasonable car, good clothes. You've got private health insurance, good hairdresser, a range of electronic equipment, repairs and maintenance to the house. So that's what constitutes a comfortable lifestyle. Now, there are factors there that, well, okay, well, I don't need that. I don't need to accumulate that much. Well, then you might be looking at a modest lifestyle and what are the functions there. So I would really refer you to that ASPA website. I just go into Google and type in ASPA retirement standard, and then up comes the listings of what you need, okay, or what people are spending to give you a little bit of an idea. They also go through what they call as it's an ugly word, it's budget. So if you've got some items there that you want to address or think, well, no, that's not relevant to me, see where you lie. But just make sure that, well, okay, well, that's what I'm looking at. If it is only modest, well, then you don't need those higher levels of figures than what we're talking about. So certainly, have a look where you lie on that spectrum of terms of spending in retirement. And then that will set you a criteria of, well, where your account balance will get to. I suppose to give you a little bit of an indication of where it's going to get to is that we have what we call Raptor. Now, it is a retirement adequacy planning tool for the accumulation account. Now, Raptor is basically designed to look at your, I suppose, the account balance as it stands, the contributions that you've currently gone through in the last 12 months. And what it will do is it will forecast, I suppose, or put some models around of where we think that your account balance will lie. There, you can make some adjustments. Are you a little bit more of an aggressive investor than what it's listed as? Are you more conservative? So it will show you the differences in what investment earnings do to your final account balance. And you then need to weigh up, well, yeah, I might be happier with a little bit more risk in my portfolio to provide a better rate of return or a better accumulated amounts when I do retire. So we'll have a look at, what sort of contributions that you can do to adjust to the account to get you to the comfortable lifestyle factor. So just remember, they're no guarantee, they're only estimates, it's only a model. I always tell people, look, I always do this product as a very conservative investor. At least then that gives you a worst case scenario. And if you're a higher risk investor, well then hopefully it's proven that the higher risk, the higher return. So there's certainly something for you to consider. So what I've done today is really just gathered some slides on the use of this Raptor tool, but I would encourage you to read the assumptions and the disclaimers before using it to make sure that you're clear on where it is going to, okay? How do you actually get into this modelling system to give you an indication on your account? So log into the portal, and up on the top right-hand corner, you'll see the word retirement projection. So you simply click on that, and then away it uses your account balance, your contributions that you're currently doing, and start you through the questions of, well, where do you think you're heading? What style of an investor you are? So it will bring you up to the I suppose, the launch pad for this tool. You can start there by reading the information, looking at the disclaimers, the assumptions and the like, and then get started. Now, the very first question that it asks, what style of an investor you are, or what is your risk profile? Now, just excuse me for a moment. I'm going to move over another screen here over at the top of the slide. I suppose the question is that, well, how do we know what sort of an investor we are? There's one simple tool that you can use, and by going onto our website and going through to what we call this risk profile calculator. Now, the risk profile calculator, I think, is quite a quick and easy tool just to give you a very simplistic approach as to what sort of an investor you are. So it basically, you go through and it asks your investment history, your preferences, your emotions, if you were to, have a negative return for a period of time. And at the end result, it will tell you what sort of an investor you are, whether you're an aggressive investor, conservative, and the like, or somewhere in between. So I recommend people to go and have a look at this product. There are other options on how we can help. I'll do those down the track. But if you want a quick self-help, getting your super on track by, a bit of a DIY sort of a scenario, then I suggest you go and have a look at that. And that will provide you with, I suppose, an answer to the question that we use on the Raptor tool is I would like to use the conservative or aggressive or whatever option for your retirement projection. So when you get to that question, the options are for the investment profiles is we've got conservative, which is our lowest risk, and our highly aggressive. What's the differences? I suppose you could say the difference is basically the long-term return. We always hear that, and a lot of people keep on talking about this risk-return trade-off. Essentially, it comes down to your comfort levels, and I always tell people it's how you pass the sleep test. Are you comfortable with having your investments in higher growth assets that are higher risk, which means that the prices fluctuate from time to time? The great thing with that is that you should be expected to get a greater return over a longer period of time because you've taken risk. So therefore, the risk-return trade-off is that, yes, you've invested higher risk, you've been given a higher reward. Now, in some periods of time, you might have volatility, and does that affect you? Could the timing of that downturn be detrimental to your account? Again, as I mentioned, do you pass the sleep test? So I certainly think that you need to have a bit of a consideration as to what sort of an investor you are. Now, obviously, a highly aggressive person should expect a higher return than a conservative investor. And therein lies I suppose, the conundrum that we have. And you should see the differences that it makes to your retirement account balance over a long period of time. Are you prepared for a given level of higher risk with your retirement savings? Generally proven is that the more we get closer towards retirement, the more conservative that we become. So certainly by adjusting that gives you gives you a little bit of room to move with your account. So once you've selected your portfolio that you choose from, it will then go away and do a bit of a calculation based on your current account balance as to where you're going to get to. Now you can see the orange chart there. It's increasing up during their working life, and there is a dotted blue line. Now the dotted line means that it's representing the comfortable standard set by ASPA for a single person for $545,000. So you can see there that this person not only meets it prior to retirement, but certainly goes above and beyond it. And the peak would be when they cease work, and then gradually over time they use their retirement savings. Now, don't be alarmed at how quickly it reduces down, simply and purely that this calculator doesn't take into effect Centrelink entitlements. So that could actually prolong the life of your investment. But certainly something to have a consideration, changing your risk profile, changing your contribution levels. Do certainly make some adjustments to this account, okay? You can then, if you wish, you can add your partner in with their basics. If they're not a member of the fund, you can add in their, their account balance, their salary, their contributions for the last financial year, and that'll give you a bit of an indication. So please have a look at that. I suppose the last, by no means least, is to make sure that have a look at the variables that it's projecting it on. Be aware of what you're looking at. Is this too aggressive? Is this something too cautious? But just have a look at the variables and the output that it produces. If you've got any questions, give us a call. So I suppose you've had a bit of a look and you think, well, okay, I'm heading in the sort of right direction, but I think I can give it a boost. I think I can add a little bit more so that I, clear that bar or clear the hurdle that I expect to get to. Well, then certainly I would have the next consideration, I suppose, what we're going to move into is, well, what are the options? What do we have a look at to put money into super? Just to remind you, if there are any questions, give us a yell on the Q&A facility. More than happy to go through those with you. Okay. There's a couple there at the moment, and I'll come back to those probably at the end. But if there's any questions that pop on up, if I can see them, we'll go from there. I suppose the question that we have is that, well, what are the options on boosting your super? Just bear with me there if I'll have a drink. How do you boost your super? So there's a range of things that you can do. Now, really there's two methods, but I'll explain why we've got the three charts there. So essentially your employer must contribute to superannuation. Simple as that. The legislated minimum is 10% of your salary. It's increased recently, and the employer must be contributing 10% of your salary to your superannuation fund. That amount is legislated to increase to 12%. So there has been a number of discussions over many years as to what the compulsory super rate is or what it should be. There was a definitive discussion of the fact that the original 9 or 9.5% that it sat on for a long period of time wasn't enough. So they've legislated it to increase through to 12%. That 12% minimum is only going to benefit someone that realistically has worked for the very first time and has their career ahead of them at 12%. For many of us, the contribution rates have been lower. So maybe it might be that the 10% now, yes, it might be for all right, or the 12% going forward might be all right for someone that's starting in the workforce soon. But for many of us that have got a few years under our belts in the workforce, that the compulsory rate of super just wasn't simply and purely enough to provide an adequate retirement savings. So we can boost it. Now, the 10% compulsory super rate is what we call a concessional contribution. Now, concessional contributions are your employer superannuation support, as I've mentioned, but they also include your salary sacrifice contributions, and there are limits to those. So that's why I've just highlighted there is that, well, look, yes, you can add to a salary sacrifice contribution, but it's something that it may not be effective for you. And we'll have a discussion of that in a moment. So yes, salary sacrifice contributions are concessional contributions and counted towards the same limit. Non-concessional contributions are those that we've paid tax on previously, sitting in our bank accounts, or it's an after-tax deduction from our salary. So all the taxes paid comes through to the fund tax-free, and you can withdraw tax-free once you've met the conditions. So they're really the two different, so concessional and non-concessional contributions, the contribution types that we have. Now, in terms of the limits. So as I've mentioned, what are concessional contributions? It's the employer compulsory plus salary sacrifice, and you may be fortunate enough for the employer to contribute more under an agreement, but that's obviously depending on your employer arrangement. Now, the limits combined for this financial year have just recently gone up. So it's now $27,500 a year. Now, when your salary sacrifice and employer contributions come through to the fund, they're taxed at 15%. Now, so we would tell people the limit is $27,500 a year. Now, there are some people that may be, subject to the eligibility criteria, can use what we call unused concessional contribution rules. So their account balance has got to be under $500,000. They may be able to use a couple of past financial years, unused portion of the limit. Now, it may mean that they can contribute a higher amount this financial year than $27,500. I would suggest that we won't bog ourselves down tonight in terms of going through the rules. I would suggest that if you're interested in going well and truly and making a larger salary sacrifice contribution or a combined concessional contribution, then contact your local regional manager, put your name in the Q&A box, and we'll get someone to give you a call to go through the rules and if it applies to you. But it certainly might be valuable. Now, remembering the 15% contributions tax is only eligible if income is under $250,000. For those people, it's taxed at a higher rate. So there are, in what we say, is the concessional contribution rules on contributing to super. So many people ask, well, why would I salary sacrifice? Now, as we've discussed, the contribution comes through and gets taxed at a flat rate of 15% into super. Now, if we were to earn income and take it in our hands, we've got to take the old unnecessary evil PAYG tax. Must get deducted from your salary. You can see there that the marginal rates of tax are higher than 15% for some people. So imagine someone who's got an income of $100,000, for example. Any income that they earn over $45,001, they pay tax on that amount of income of 32.5%. Any of their income that's in the bracket of $18,200 to $45,000 is taxed at 19%. And obviously everyone's entitled to the tax-free threshold of up to $18,200. So you can see there it's what we call a marginal rate of tax. The more you earn, once you go over thresholds, you pay a higher amount of taxation. You can see there that for the majority of us, there is some benefits in salary sacrificing to super. You can see there that instead of having income being taxed at maybe 32.5%, we can push it directly through as a salary sacrifice contribution, get it taxed at just 15% to therefore boost your retirement savings. So you could say that you're getting a little bit of a tax incentive to contribute to your superannuation account. Okay, so I would note that you need to have a look at this each and every financial year as to your income levels. Make sure that you're getting the right or paying or contributing on a basis that's effective for your salary. Okay, so the next slide here, I suppose you could say, is what we've done as a basic salary sacrifice example. The one thing that I would refer people to is that back to our website, if you go to the education portal, you can go onto a contribution calculator. Now, the contribution calculator there, you can go through and do an example of this calculator. And let's say, for example, if you're earning $2,000 a fortnight and you wish to contribute 5%, your employer's getting 10% super, it will do a comparison of your income on whether you do it on a salary sacrifice basis or an after-tax basis. And I think this is quite a valuable exercise. Simply and purely is that you will highlight the fact that, well, because your salary is being reduced, because your employer is contributing the 5% through to superannuation, your taxable income reduces, but your PAYG tax reduces for a salary sacrifice. So you can see there that when you start salary sacrificing, as opposed to doing an after-tax contribution, because you're paying tax on every single dollar that you earn at a higher rate, you can see there that the take-home pay is a little bit higher. But you've got to remember is that when this contribution comes through to superannuation, it will be hit with a higher level of contributions tax. So you can see here, looking at the overall situation of comparing, you can see that this person here, by just making a 5% contribution towards their super, ends up overall being around about $400 better off. Now that's $400 better off in their retirement savings. So it's certainly a thing that you need to look at. Now, the one thing that I would remind people is that this person was eligible towards the government co-contribution if they were to do an after-tax. So there's a few things that you need to have a look at and tweak depending on your salary as to which way you contribute. Do you salary sacrifice or do you do after-tax contributions? And that's where I would always refer people to the website, to the calculator, to the contributions calculator that's shown here. And that will provide you the example as to which method is best for you. I suppose the next item is that we need to have a look at is how much contributions are you wanting to send through to superannuation. So we've talked about salary sacrifice, the limit being $27,500. So now let's just say that, well, okay, salary sacrifice, I've capped that out. That's not the end of it. You may be able to make what we call non-concessional contributions. So I explained there before, non-concessional contributions are those contributions that are come to the fund after tax. They come through tax-free into entry to the fund. So you've paid tax on every single dollar that you've earned. And then from there, they accumulate within your superannuation. Now, the limits to these are quite high. So anyone under 67 years of age can contribute up to $110,000 a year in terms of contributions. They can use some bring forward provisions and contribute up to $330,000. And that's only over going for a 3-year time frame. So certainly under 67, it's quite flexible. Okay, and those rules have just recently changed as well. Now, after age 67, but up to the age of 74, the limit is just $110,000 a year. You must meet a work test, which is 40 hours over a 30 consecutive day period, and you've got to meet that work test before you're eligible to make these after-tax or non-concessional contributions. So therefore, you can see that $110,000 limit. You might find, obviously, you can't use the bring forward provision, but certainly you'll be capped out at that $110,000 amount and go from there. Now, once you turn 75 years of age, you can no longer make further contributions to your superannuation account. Okay. There are other investment vehicles available to you that you can use. But the great reason for these contributions is the fact that you've paid tax on the money, you might have won an inheritance. You might have got an inheritance and all won lotto. Bit of a slight error there. So these come in tax-free. Okay, they boost your account, and it's a wonderful way of boosting your account prior to retirement. But you just need to be very timely or very careful in terms of the age that you are at. If you're reaching those age limits, and it might skew your eligibility to make those contributions. So they're more than happy for you to have a discussion with one of our staff. There are a couple of other ways that you can top up your superannuation account. The downsizer rule was a rule that was brought in for people that are over 65. It's legislated to go to people under 60. And basically, it's above and beyond those contribution limits that I've just spoken about. But if you're selling your principal place of residence and you've been in it for longer than 10 years, you'll be able to make a top up to your account. I won't dwell on this one too long, but all I can say is that many retirees are utilising it to unlock some capital in their retirement, because obviously with real estate as it is going through the roof and they're downsizing, they can use this, newborn capital to fund their retirement. Many people are doing that. The other item is spouse contributions. If you have a spouse with an income below $40,000 a year, you will be able to make a contribution to the spouse's account and gain yourself a tax rebate. Now, I work with a colleague that was a former tax accountant, and she always gets very excited when we start talking about tax rebates. Any rebate's a good rebate. And especially if you're closer to retirement and looking at ways to not only boost spouses' accounts, but also gain yourself a tax rebate, then I would encourage you to have a look at the spouse contributions. And all of that information is available on our website, or otherwise have a look at the ATO website. There's some valuable information there. Obviously, consolidation, okay? If you've got other superannuation funds out there, it might be wise for you to consolidate and bring them into the one house. You can do that very easily these days. If you use your MyGov account, you can actually transfer the accounts electronically through the MyGov facility and bring them over into the one final account prior to retirement. Or otherwise, if you just want to, consolidate now and to reduce your administration fees, you can certainly bring them together. The one thing I remind people though is that you might be holding on to that superannuation account for insurance purposes. That doesn't change. You can transfer the insurance over to our fund, but there is a bit of a process with that, and I'd encourage you to speak to one of our staff before you go down that process, because once you close that account, you're closing off any future those eligibility to those insurance benefits. So you need to make sure that you continue to remain covered. So that's 3 other ways, apart from personal contributions that we discussed, on how to boost your superannuation. So if you've got any questions in regards to those, please do not hesitate to shout out, and we can more than happily go through those, any other questions that we have. I suppose the next item that we want to discuss about is the Your Future, Your Super legislation that was recently announced and brought into effect. Now, the Your Future, Your Super legislation, I suppose, was introduced to compare superannuation funds over a 7-year time frame. Now, we have a default product, and it's tested on the default options within our fund, not on the other 13 choices within your super, but just that default option. We have a default option called Lifetime One. Now, we will talk about that in a moment, but essentially the performance test was introduced. There was a lot of conjecture within the industry into, the practical application for it. It was only recently legislated in July of this year, and the regulations on how the test would operate were released very late in August. Now, the fund was notified very late in August that our MySuper option did not pass that test. Now, as I said, Lifetime One is our default option, but it has only been available in the fund for the last 3 years. It is previously using what we call our conservative balanced option. So what they're doing is splicing a 3-year return on Lifetime One and pushing into it our former option for conservative balanced. Now, that has come together to determine the test output. And unfortunately, the combination of these two products meant that we didn't pass this mandated test. So as I've mentioned, we've notified the members that are invested in this product already. It doesn't apply to the 13 other investment choice options that we've got available. And certainly there are a number of options that are available in terms of risk structure that we spoke about. We don't know of our exact position on the benchmark yet, although we believe that that will be announced soon. The reasons why for the underperformance is that historically, our shares portfolio didn't perform as well as the statutory benchmark. That was back in I suppose, years 6 and 7 of the historical test, and ending the financial year ending 2018, we restructured our shares portfolio, and they've certainly, for those people that have been in those share options, the returns have certainly been, have been quite available and quite competitive. The other item is that our alternative assets, or what we call infrastructure investments, have been actually benchmarked against assets that they're not really true to form. They're probably not as aggressive as the benchmark that they're up against. So therefore, that has negatively impacted our return in this test. So we've previously acknowledged this underperformance within a couple of portfolios, particularly Australian shares and international shares. But since then, and since the introduction of Lifetime One, it has done everything that we have wanted it to do. To give you an explanation, Lifetime One is what we call a life cycle investment. So my kids are invested in Lifetime One, simply and purely that over the lifetime of our product, it starts at the age of under 40. If you're invested, you're extremely high risk. And as you age from the age of 40, it becomes more and more conservative over time. So the product as it stands has been quite good for them, being under 40. They've had some fantastic returns, and I'll highlight to you those in a moment. The one thing that the letter did encourage members to do was to have a look at the super comparison tool. And I actually recommend people to do that and certainly compare our product. And what we would say is that have a look at our 3-year performance and compare that to those over the same timeline of 3 years. And certainly the fund performs quite well. But unfortunately, due to historical issues, it's been labelled that as an underperformer. So I suppose within the industry, there's been a lot of conjecture about this performance test. Yes, we've got a product that's only been three years around, but it's been subjected to a 7-year test. There's a lot of media articles out there, and I'd welcome you to go to our website in terms of that information. And we can provide you with some more detailed information if you want to have a look. But have a look at the figures that are in that performance tool, comparison tool, and I'd certainly encourage people to have a look at that 3-year timeline. Now, I suppose what we have said to people is that Lifetime One has basically performed, as what I mentioned, performed to what it was intended to do. Members up to the age of 40 are invested in what we call Lifetime Start, and they've nearly earned, I'd say, a slightly under 20.9% last financial year. A fantastic return as a result of investment markets going through the roof over that financial year. So those younger members under the age of 40 have been exposed to quite high risk investments, but they've been rewarded in that last financial year, hence the performance. The one thing that I would state is that the great thing with this product is that from the age of 40, it becomes more and more conservative. Okay, so once you get to a point, there might be a product out there that you can compare that's like a balanced portfolio that's fixed for everyone. So whatever you are, like say, for example, our balanced portfolio, we've got a growth to defensive structure of 75% growth assets, 25% defensive. Well, Lifetime One, it's significantly higher for the 40s, 45s, and then gradually it becomes a little bit lower risk than a balanced portfolio once you're starting into the areas of 60, 65 and 70. So you can see here the performance for the last 1 year ending June and the 3 years ending June, the average. And you can see there that the 40-year-olds, as I said, 20.88%. The more conservatively invested, without taking a huge amount of risk, we need to be mindful of that, because you make sure you're comparing apples with apples, return 9.4. It's quite a very conservatively invested area once you get to those higher age brackets. So we encourage people to look on the super comparison tool, but be mindful of what the underlying investments are. Do a bit of research. But you can see there that the 3-year performance to June, the 3 years average to June, you can see there that those people that have taken higher risk have been rewarded over that short period of time. Like to think that continues out. So those ratings there from Super Ratings, you can certainly have a look at the performance, but the one thing that we would always say in the industry, you should never base an investment decision on past performance. Items change. The best performer one year may not be the best performer next year. You need to make sure and be fully aware of all the different investment options. So I suppose the outlook for the fund. I suppose the one thing that the trustees have continued to run our fund in a way that we've made sure that we've looked after members and their members' best financial interests, and they're not going to change that mantra. The fund has been a trusted superannuation provider for over 35, 40 years. We continue to act in the best financial interests, and the strategy going forward is that the clear strategy going forward is that we will be looking to a merger partner that's a distinct size. Simply and purely, the government regulations for all of this performance test was to make sure that funds were large enough, and they came out publicly and suggested that funds need to be in excess of $50 billion to survive going forward. Our fund is currently $10 billion. So to make it more effective, our trustee is currently in the process of looking at merger partners. We're certainly not too far away of announcing in the next 1 to 2 months, hopefully, a merger partner that we will be looking to go forward. And once that announcement is made, it won't be 6, 8 months after that we'll be looking to merge into that larger entity. Once you've got that larger fund, you've got the economies of scale. You can offer and provide higher functioning website portals. You can provide a range of investment options. But more importantly, fees and costs become more competitive when we're in a larger area. So that's certainly the area of the fund that we're looking at. I would suggest that if you've got any questions, to contact your local regional manager. We can provide you with any assistance that you have, any questions on your account, investment options that you can compare, and run through the super comparison tool if you like. But there are a number of options, but certainly there is an exciting future that awaits the fund, in a sense that down the track in the not too distant future, we'd like to have a merger partner that is announced, publicly available, and certainly our external consultant is currently in the process of narrowing that list down. The trustee board will be making a decision very soon in regards to where it's going forward. So I'd certainly, you've got any questions, give us a yell. So I suppose in terms of how we can help going forward is that there are some general information that you can gain from the fund. You can call the call centre. The very helpful staff that are available in our call centre may be able to help you with some inquiries on your accounts, go through items. If you want to have a discussion with your local person, there is a regional manager in your area, or relationship manager in your area that you can discuss with. You can actually have a chat to them on the form within the chat facility if you wish. I believe my assistant in the background was going to be putting that through there. They will be able to provide you with that link, and you can go there with that link to that if you wish to have general information. So I suppose the thing is that the options you have is that we can provide you with general information, general superannuation questions about your account, whether it be on the looking at an allocated pension plan? Do you have a look at the forms that are available? What account information there? We can assist with the Raptor demonstration. So I suppose I would suggest to people is that you do want to have a link to that. Click on that link that's just been placed there now. I must say, I think I've just given a slight general nudge to my helper, Justin. So if you want to have a discussion about the general items that are about your account, about the performance test, click on the link and we can arrange for someone to give you a call. In today's session, we also had a look at a number of things about salary sacrifice, your investment options and the like. Now, the one thing that the fund can provide is that we've got a facility there that we can provide you with limited advice over the phone at no further cost to you. So if you want to know should I salary sacrifice and how much should I do, and how this will affect your take-home pay, then these people will be able to take you through over the phone at no further cost and provide you with some clear guidance. Like I've shown and highlighted to you the tools that are available for self-help, but if you want a bit of a helping hand, these great people within our limited advice team will be able to provide you with that. The investment options there, in terms of MIC options, what style of an investor am I? They will take you through those questions, give you a bit of guidance as to what investment options are best for you. The other thing that they can do is help with your insurance benefits. Do you have enough? What is a reasonable amount of insurance coverage? So I would suggest that you have a look at your insurance benefits there. And if you want to get an appointment, click on that link and you can go through and get an update to your account. I always say to people is that getting a helping hand at times here in the fund, it's just a matter of a phone call away. It's at no further cost. One time after work, I would suggest you sit down with one of these planners, sit down with one topic, and they can go through whether you need the others as well. So it's certainly a great facility for the fund. If you have problems getting onto that link, call the 1300 number. The other item is that many people look for is that they utilise our comprehensive facility. I suppose the items there is the comprehensive advice is quite a detailed process. But I always tell members that it's best to speak with them to make sure that you're fully aware of all financial situations or structures that are available to you to make sure you maximise your benefits. Now, financial planners in our superannuation fund, yes, there is a fee to conduct those appointments. The first appointment that you meet with these planners are complimentary. And the process would be is that you would meet with them, you would provide all of the information on your account, and then they would provide you with a quote going forward. So the discussion on the day or the first appointment is about an hour and a half. They discuss with your goals, your strategies. They look through all of your assets, your liabilities, your income, your budget. It's quite a very detailed conversation. And out of that, they will provide you with a recommendation to go forward. Yes, we can help you. Now, they will only progress to that point if there is a benefit in doing the advice, i.e., what's the benefit? Well, you'd want to make sure that they can value add more than the fee that you pay. Now, if I was to sign up for $2,500, I'd want to see at least $3, $4, $5, even more $1,000 worth of savings. And that's what they do. That's their job. So I always say it's nothing ventured, nothing gained. The first appointment, they can sit down, discuss with you your options. But at the end of that, you get a very detailed strategic document of where you're going for your future. I think it's a brilliant document in the sense that it projects your retirement projection through. It signifies what, I suppose, where you're going to get to prior to retirement. And it also then shows you how long this funds will last in retirement. That's not the only items. They'll guide you through the contribution limits. They'll look at, making sure you get bang for your buck in your retirement. And then they also have a look at, what eligibility to Centrelink, how long is it going to last. But the other items is that, well, maybe superannuation is not a full vehicle for you. They look at non-superannuation investment. So if you do want to have a sit down with these consultants one-on-one, get some advice, click on the link, or otherwise go fill out the survey, or otherwise give the fund a call on 1300. I suppose tonight that comes to the end of the session. I suppose the things that I always tell members is what I've learnt is that I would encourage you to just have a look at your account online. Go in, log online, check the portal, have a look at that Raptor demonstration, that model, see where your account's heading. If you've got any other questions, there's regional staff, there's call centre staff to assist you with your account. I think it's crucial for us to take, I suppose, a few decisions, and it's quite easy decisions to make, to ensure that we get the right outcome that we deserve. Justin, I noticed that you've come on there.
Before?
I haven't been keeping too much of an eye on the Q&As. Is there many Q&As there that we need to go through?
There's been a couple of questions come in, Paul, but I noticed, true to form, that you've gone right up to time. You've kept us all entertained, but
sorry,
there is a few questions there. But what I might just ask one or two of them have come through, and then the other questions
we can get back to the members.
I was just going to say, don't feel that we're ignoring you. One of the local RMs will call you in the next 24 hours to answer those questions. But the first one is, what type of insurance do you offer at the fund? Because I heard you touch on it earlier, and this person said that they're just going through getting a mortgage at the moment, and they've been asked to get life insurance with a mortgage.
Yeah.
Could I have done that through the fund?
Yeah, okay. I suppose there's the three main types of insurances. We'll keep this quickly, or try and keep it Justin quickly. There's death, there's total and permanent disablement insurance, and they're lump sum amounts that can be paid out on the event, on those two events. The other insurance is income protection. So income protection, if you're employed by a Catholic agency, we'd have your salary, or we should have your salary, and your insurance benefits there. I would encourage you to go to the portal, have a look at your insurance benefits. They're quite listed there. If you want to get a quote, I would say it's quite easy through our structure. The one thing that we do stand out on is that our fund has been an award winner for our insurance benefits that we've got, and we're very competitive in that market. Our goal is to make sure that all people are covered, protected. So I would suggest go to the portal, or otherwise call the local regional manager, and we can give you a bit of a quote there.
Thanks, Paul. And just the other one, the last one I'll ask you is, how do I salary sacrifice? I'm trying to do it on my employer's portal at the moment. I just can't seem to do it.
Okay. I would suggest you make contact with your employer. We do have forms in the fund that you may be able to submit. Again, ring the call centre or ring your local regional manager, get them to give you a call back. They can help with the process of filling it out and then submitting it to the employer. I would suggest that you either look online to your employer's portal, or otherwise fill out the form and email it to the payroll office.
Well, this person said that they're in one of the Sydney employers, and I know that the self-service there doesn't offer salary sacrifice. So you hit the nail on the head. We do offer, or we do have that form on our website that you can use, or you can request one of their forms. It's
due to the legalities, most of them. Due to the legalities, I think most employers now would prefer a form completed with a signature.
Thanks. So, and the last one I'll give you, Paul, and it just snuck in. There are others, but this one is quite topical, and people do get confused about this. Lifetime one, is that the same as lifetime start? I'm okay, someone gets back to me later. We will get back to you later, but Paul, you just want to touch on that? Yeah.
So I suppose that lifetime one is a product. within lifetime one, there are 4 distinctive building blocks within the product. And I must admit, I get sometimes confused as to the order of those. So I'll provide you with that information. But basically, lifetime one, we start off with an investment in lifetime start and lifetime grow. So there's the first 2. As we become a little bit older, we get into a combination of lifetime grow and lifetime build. And as we get closer towards retirement, we become into lifetime build and lifetime prime. I get that order mixed up every time.
I was reaching for my notes too, Paul.
So I would say lifetime start is a part of lifetime one, and I would refer yourself to that person to the investment fact sheet, and it'll show you how you phase through all of the different building blocks of lifetime one. So there's 4 pillars to lifetime one, and you move through them over time. Okay, is that it, Justin?
The other questions we'll get to, because I can see that people are dropping off, and also we've got about 5 minutes overtime. So people probably want to get to their dinner and have some family time and so on.
Yes.
So
apologies. I always do it every time, Justin. Thank you all very much for joining tonight. We appreciate your time. If you've got any questions, give the 1300 number a call. Again, we're always here to help. If you've got any questions, more than happy for you to reach out to me as well, and I can provide you with some more information. But again, thank you very much. Thank you much, Justin, for your assistance tonight. And again, have a good night. Thank you.
thank you.